In Chapter 16, we look at financial statement analysis. This is an example where we're going to do the three types of financial statement analysis on information for a company. So the three types of financial statement analysis are horizontal or trend analysis, if you remember from the chapter, vertical or common size analysis, and ratio analysis. We're going to start with the vertical analysis or common size analysis. In common size analysis, that is where we take everything on the income statement as a percentage of sales and everything on the balance sheet as a percentage of total assets. So I'm going to start by copying the labels for my income statement below here. And this is vertical or common size. So we take everything as a percentage of revenues. Revenues is 100%. In Excel, we want to set up our formula so that we can copy it. So we're going to divide everything by revenues. That means we want our denominator to be a locked cell so that we can copy that formula down. So we're going to lock our denominator cell in Excel. Then we can copy that formula all the way down. We're going to change it to a percentage and do at least 2 percentage points out. Format the rest of these cells to be percentages. And we do that for each year. We have the information for 2020, get the information for 2019, revenues divided by revenues, lock our denominator cell, and copy down for 2018. And 2017. Now we have everything represented as a percentage of sales. This allows us to look at information as it relates to sales. It's easier for us to interpret percentages than dollar amounts when we're looking at year-to-year information. You can see up here that we have a pretty significant change in revenues and expenses from 2017 to 2020. When we're just looking at dollar amounts, it can be difficult to tell whether those dollar amounts are significant changes or not. But if we change them to percentages, we can see that we actually have a pretty regular pattern for how much our cost of goods sold and our gross profit is in relationship to sales. We can see that in 2020, we have reduced some operating expenses, but otherwise we stay fairly consistent across all of the years. We'll also do our balance sheet. Again, I'm going to start by copying my labels and pasting them below. We're going to start with cash and cash equivalents. On a balance sheet, we want everything to be shown as a percentage of total assets. So total assets will be our 100%. That's what we're going to divide everything by. That will make stockholders' total liabilities and stockholders' equity also 100% because we know that they have to equal each other in a completed balance sheet. So we're going to start with cash and cash equivalents divided by total assets. The reason we're starting here, even though total assets is our 100%, is so that we can copy the formula down just like we did with the income statement. We're going to start with the first column. So we're going to lock that total assets cell. That's our denominator because we want everything divided by that. And I am just going to copy that all the way down to save time, turn it into a percentage. And then what I'm going to do is I'm going to go remove the 4 rows where there's no information or it's just a header in order to help me keep that. It's just faster to copy down and then go in and remove those 4 rows. So we're going to do that for every year. Take everything in the balance sheet divided by our total assets, locking that total assets cell so that we can copy the formula all the way down, formatting as a percentage with at least 2 points out after the percentage. And removing the 4 rows that don't have numbers. Remember that you should be consistent. If you have put it out 2 decimal places, then all of your percentages should be 2 decimal places. If you choose 3 decimal places, everything should be 3 decimal places. Consistency is one of the important factors when you're formatting an Excel spreadsheet, that all numbers are represented the same. If they're dollar amounts, you can tell that they're dollar amounts. If they're percentages, you can tell that they're percentages. Next, we're going to do the trend or horizontal. We're going to do the same exact thing where I'm going to copy the labels down below and the years. And this is horizontal analysis or trend analysis, it's called. So in the horizontal or trend analysis, we're looking across. So in the vertical, we're looking up and down. Everything is a percentage of one thing. In the trend, we're looking for trends. So we use a base year, generally the oldest year of our information. So we have 2017 here as the oldest year of our information. We use a base year, we take everything divided by the base year. I want everything in here to show up as a percentage, so I'm just going to go ahead and format my cells right now so they're automatically percentages. We're going to start with 2020. So for this, I want revenues from 2020 divided by revenues in 2017. And I want everything, all revenues from every year divided by the revenues in 2017. So I want 2017, the entire column for 2017 should be 100%. That's our base year. Everything else should show growth or decline from 2017. The entire 2017 column should be 100% when we're doing horizontal or trend analysis. So we can see trends here, like we have a 30% increase in revenue from 2017 to 2018, 7.7% increase from 2018 to 2019, and then a big increase from 2019 to 2020. We usually use trend analysis in order to forecast for the future. So if we have regular trends like 28 to 30% growth every year in revenue, it's easier for us to project that information into the future. When we have big leaps like we do from 2019 to 2020, we can't really guarantee that those are going to be repeatable leaps. So if we're using that information to forecast to the future, we're going to have to take into account that that's not a normal trend. We would also want more than 4 years of information to really give good forecasts. So we do this across for every line. We have cost of revenue from 2020 divided by 2017. We're going to lock 2017 so that I can copy that across. I'm going to do that with every line in the income statement and the balance sheet. Now that we've completed the income statement, you can see that 2017 is all 100%, and then we show the growth trends from 2017 forward to 2020. We do the same exact thing for the balance sheet. I'm going to start by copying my labels, create that information below. You can do it beside also and go across. There's no rule that says it has to be below. This is our horizontal or trend analysis. We're going to format everything to be a percentage. Okay. And we do everything as our base year. So everything from 2020 is divided by 2017. We locked 2017 so we can copy that across, and 2017 should be our 100%. Once we complete every line in the balance sheet, we can see that the 2017 column is all 100% and everything else is showing growth. So we can look for trends in the growth, look for outlier patterns. You can see some things have not changed. Common stock, so remember that common stock is recorded at par. And so the amount of common stock that we have generally does not change unless we sell additional common stock. That our treasury stock hasn't changed for 4 years. Treasury stock is when we buy our stock back from the marketplace. So they haven't purchased any more since 2017. That's remained consistent. And we can look for growth patterns that if we're growing too much in debt, we might have concerns. We can use this information together also. So we can come up and we can see here that our accounts receivable amount is decreasing, which means that we're maintaining a good accounts receivable. Our customers are paying us. They're paying better in 2020 than they were in 2017. Our accounts payable are fairly consistent. Accrued expenses are fairly consistent. And so looking at that information and how it relates to each other from both of those things. The last analysis that we do is ratio analysis. So there's a PDF in week 14 or in the chapter 16 information for on my.Wartburg. There's a PDF listed that has information about all of the ratios from the chapter, what they measure, the formula to calculate them. There is also a page in your textbook where everything from chapter 16 is included in a summary table. That page is 752. That has all of the ratio formulas and tells what they measure. So we're going to go through all of these ratios. The first ratio we start with is working capital. Working capital is current assets minus current liabilities. This tells how able a company is to pay off their liabilities over the next year. So do they have enough available in current assets that they can cover any debts that are current and need to be paid within the next year? So we go to our balance sheet and we take current assets, total current assets, minus total current liabilities. We can copy that formula across, and that is formatted as a dollar amount. I'll have to make the cells a little bit wider to see those. Next is the current ratio. This is similar to working capital as it is current assets and current liabilities, and we're looking at our short-term debt, our ability to pay our short-term debt or our current obligation. This is current assets divided by current liabilities. So we take current assets divided by total current liabilities. A company wants this number to be greater than 1. So we can see across all 4 years we're greater than 1. So this company has the ability to pay all of their current liabilities with their current assets. Their current assets are greater than their current liabilities. The acid test ratio, which is also called the quick ratio, uses quick assets instead of current assets. For the acid test ratio, this is cash and cash equivalents plus accounts receivable divided by current liabilities. What it does is it moves any prepaid assets and inventory from the current calculation. So that's what we have, the current assets and the current ratio. And the acid test ratio, where we remove prepaid assets and inventory, because we know that we can't get the cash back from prepaid assets, and we can't guarantee when we turn inventory into cash. So it's looking at what do we have available just in cash to pay our liabilities over the next year. So we're going to add cash equivalents plus accounts receivable and take that number divided by total liabilities. Total current liabilities. So this number is below 1. So this tells us that this company, they don't have any prepaid assets, but they do have inventory. That means that they do rely on the ability to sell inventory in order to pay their debts off for the next year. Accounts receivable turnover is how many times a company's accounts receivable is turned into cash throughout the year. So that is sales on account divided by average accounts receivable balance. If we don't have the sales on account separated out from sales revenue, then we use sales revenues. So we use total sales revenues from our income statement divided by average accounts receivable. So that's accounts receivable from 1 year plus accounts receivable from the previous year divided by 2. If you don't have, when you get to 2017 and you don't have previous information, just divide it by the 2017 amount, or instead of doing the average. But for every other year, you should do the average. So on average, we turn over our accounts receivable 17 times a year in 2020. We can copy that formula across. We can see that since 2017, the number of times, oh, I need to fix, there is no number in 4. So you can see this is consistent with the fact that our accounts receivable is declining, that we are getting faster at the number of times we turn over receivables. The average collection period is how many days it takes us to receive cash from a credit sale. So this is 365 divided by the accounts receivable turnover. So on average in 2020, it took us 21.4 days to receive cash after a customer bought something on account. We can also see that this is improving. It's taking less days. When we're looking at trend information, we would want to see this number staying consistent or decreasing. If this number is increasing, that tells us that we're starting to have cash flow issues because our customers are taking longer and longer to pay us for their credit sales. The next ratio is inventory turnover ratio. Inventory turnover ratio is very similar to accounts receivable turnover, except we're going to use inventory numbers. So we have cost of goods sold and inventory. We take cost of goods sold divided by average inventory. So cost of revenue, just another term for cost of goods sold, divided by, same thing, that average total revenue or average total inventory. We add 2 years inventory and divide by 2. So we turn over inventory an average of 13 times a year. I'm going to fix the formula for the last year by removing that average. This is also improving. We're selling inventory more often than we were in 2017. So this shows good information. Our average sales period tells us how many days on average a piece of inventory sits on a shelf or in a warehouse before it is sold to a customer. So we take 365 days divided by the inventory turnover. So on average, in 2020, we had 27.7 days for us to sell any given piece of inventory. Now remember, this is an average across all inventory. And if our company has a very diverse array of inventory that we're selling, some inventory could be selling every day, while other inventory takes 50 to 100 days. So this is an average across all inventory. Operating cycle is the measure of how long it takes us to collect cash after we have purchased inventory as a company. So the time it takes from when we get inventory from a supplier until a customer pays us cash for it. That is the average sale period plus the average collection period. So on average in 2020, it took us 49 days to receive cash once we ordered inventory. Again, this number is improving. It was almost 70 days in 2017, and we've managed to remove 20 days from our operating cycle. That is very good news for our cash flow. That means we're generating cash faster. We're moving inventory faster. Our customers are paying us faster. So we are increasing our cash flows from our customers. Total asset turnover measures how efficiently we use assets to generate sales. So that is net sales divided by average total assets. So we go to the income statement and we take revenues. We divide that by, remember, average total assets is total assets from 1 year plus total assets from the previous year divided by 2. Take that across to copy it so it's faster to copy formulas. So what this tells us is for every dollar we have in assets, we are able to generate approximately $1.40 in sales. The next ratio is times interest earned ratio. These next three set of ratios are debt management ratios. So how able are we to pay our debts, our long-term debts? Are we a financial risk if we were to go to a bank and ask for money? The debt times interest earned ratio looks at the company's ability to make interest payments. So the times interest earned ratio is operating income. It's income before interest and taxes. So operating income, or on some statements, it's called earnings before income and taxes, or EBIT, divided by our interest expense. If you don't know the interest expense, you can't really calculate the times interest earned ratio. So we are able to cover our interest. This has greatly increased since 2017. So we've really increased our ability to pay interest payments and any long-term debt. Next, we're going to look at the debt equity ratio. So this is the amount of assets being provided by creditors versus the number of assets provided by stockholders. So remember, debt is money that we owe out to people. Bank loans, bonds are all types of debt. And equity is what our owners have put into the company. So our stockholders, our retained earnings, things that the company has as investments. So for this calculation, we take total liabilities divided by total stockholders' equity. So we can see here that we've improved our debt to equity ratio, but we still are carrying $2.40 in debt for every dollar that we have in equity. Our equity multiplier is the average total assets divided by average stockholders' equity. This measures the portion of a company's assets funded by equity. We'll take average total assets, 2 years, divided by 2, divided by average total equity. Equity from 2 years divided by 2. And that gives us our equity multiplier. In the last year, we would just take the total assets divided by total stockholders' equity. Okay, when you take business finance, which is the next course that you would take after Principles of Accounting 2, we will come back to these and we will expand on these calculations as a discussion of how much debt is beneficial for a company to carry before they start getting into the risk of bankruptcy. Next, we have gross margin ratio. Gross margin ratio is our gross margin divided by sales. Gross margin, or gross profit, divided by revenues or sales. This is generally expressed as a percentage. And net profit margin is net income divided by sales or revenues. So net income divided by revenues. This is also expressed as a percentage. So the percentage of every dollar that we get to keep from sales after all of our expenses and taxes have been paid, and gross margin is what is left over after our cost of goods sold. Return on total assets is a little bit more complicated. So you can see the formula here. It is net income plus interest expense times 1 minus the tax rate divided by average total assets. This tells us how well assets are employed by management. It is also generally shown as a percentage amount. This is also one of those calculations that if you don't have the interest expense, it's difficult to calculate. Return on equity is the measure to which financial leverage is working for or against common stockholders. This is net income divided by average stockholders' equity. So we take net income divided by average stockholders' equity. So remember that stockholders' equity from 1 year plus stockholders' equity from the previous year divided by 2. This is also expressed as a percentage. The last set of ratios are market analysis ratios. This looks at our stockholders, how many shares we have outstanding, how much of a benefit we are to stockholders. These are measurement of how good of an investment we are, whether or not people would want to invest as us as a business. Earnings per share is net income divided by the average number of shares outstanding. Companies will supply you with the number of shares outstanding because it's a very difficult thing to calculate. So they just give you this information. So we take our net income divided by shares outstanding. We want the basic average shares. So the diluted average shares means that they have some kind of a stock option available in the world that would increase the number of outstanding shares if people took those options. Different examples of stock options, if you can remember from Principles 1, are convertible bonds. So these are bonds that can be, instead of receiving the cash for the bond investment, the owner can choose to convert that into a number of stock shares. Another example of diluted average shares would be that instead of cash bonuses to our employees, we give them the option to buy stock. And if they take that option, they get shares instead of getting cash. The reason that companies are required to provide this information is because if we increase the supply of stock out on the marketplace, we often decrease the price. So anyone who's investing in a company is going to want to know that there's a potential for an increase in the amount of shares outstanding. That is why that information is required for companies to share, but we are not looking for that information in the EPS. We want the basic average shares. So we have $42.66 as the earnings per share. We can see that that has increased greatly since 2017. This would tell us that this stock is a good investment. The price earnings ratio is an index of whether a stock is cheap or expensive in relationship to current earnings. This is our market price per share divided by our earnings per share. So we have our market price per share, and we take that divided by our earnings per share. So we have that it's still a fairly expensive stock, but It's not as expensive as it was in 2017. In 2017, compared to the earnings per share, this was a very overpriced stock. It wouldn't have been as good of an investment in 2017 as it is in 2020 when compared to earnings per share. The next two are dividend payout ratio and dividend yield ratio. So this particular company has never paid dividends and has said that they never plan to pay dividends, but just for the sake of doing these calculations, let's pretend that they have paid dividends. So I'm just going to make up some numbers. The zeros out. Okay. So for the dividends paid, the number you're given is total dividends paid. And what you want to calculate is the dividend per share. So we would take the total dividends paid divided by the number of outstanding shares. I'm actually going to put zeros on this. So now we have dividends per share for each year. So for our dividend payout ratio, we take the dividend per share divided by the earnings per share. So our dividend per share divided by earnings per share. This is expressed as a percentage. And then our dividend yield ratio, which is dividends per share divided by the market price per share. So this is a measure of the return in terms of cash dividends provided by a stock. Okay. We will also revisit all of these calculations in business finance and add on to them for investment perspective calculations. The last ratio we have is the book value per share. So the book value per share is our historic value. So remember, the book value per share is very different from the market value per share because we sell stock at par value and we record the par value and the paid-in capital. The other thing included in our book value per share is retained earnings because it's part of total stockholders' equity. So this is total stockholders' equity divided by the basic number of shares outstanding. Another reason that the book value is different, if you remember from Principles of Accounting 1, is that the company only receives cash for their stock the very first time it is sold on the marketplace. The second time it's sold, it's the owner of the stock who receives that cash income. So the company only receives money one time for shares unless they've purchased back treasury sales shares and would resell those. So we take our total stockholders' equity divided by the basic shares outstanding, and we get our book value per share.